Hello friends, my name is Behroz and welcome to my channel. I'm a finance executive by profession, and in today's video I will talk about how you can smartly withdraw money from your RRSP while paying minimal to no tax at all. Now let me remind you what an RRSP is. An RRSP is an account where you are making contributions, and when you contribute to this account you save taxes on those contributions. For example, let's say your marginal tax rate in a particular year is 40%. If you contribute $10,000 to your RRSP in that year, you save 40% of that $10,000 in taxes, which is around $4,000. Amazing. However, an RRSP account is a deferred tax account, which means you will eventually have to pay tax on that account or on that amount that you will be withdrawing. So once you withdraw that amount, you will be taxed on it. What you need to do is minimize that tax rate using the strategies that I will explain in this video. The idea here is to withdraw money in a way that minimizes the tax you pay on those withdrawals. Now, before we dive deeper into these strategies, if you find any value in this video, I have two requests. First, please hit the like button, as this keeps me motivated to improve the quality and quantity of content I post on this channel. Second, please subscribe to the channel. On this channel, I post content related to career success and personal finance. So if you are interested in succeeding in both areas, this channel is right for you. Now, let's get into the strategies. The key idea is to take out your money in years when your tax rate, or call it your marginal tax rate, is at its lowest. You should be contributing to your RRSP when your tax rate is high, so you get maximum benefit. So you contribute in the years when your marginal tax rate is high, so you get maximum benefit. But when you're withdrawing money from your RRSP, your tax rate should be as low as possible. Now remember, your tax rate is lower when your income is low, because your tax rate is determined by your income. The higher your income, the more tax you pay as you fall into higher tax brackets. But when your income is lower, it's beneficial for you to take out more money from RRSP. For example, if before retirement you have a year when you don't have any money, perhaps because you lost your job or decided to take a sabbatical, those are the years when you should be withdrawing money from your RRSP. However, be cautious not to take out too much money. Withdraw it in smaller chunks, enough to keep your income low for that year. If you withdraw, let's say $15,000 from RRSP and you have no other income in that year, that $15,000 becomes your income. In provinces like Ontario or federally in Canada, that $15,000 may not even be taxed, or it may be taxed at a very low rate. But if you withdraw a large amount, you may move into a higher tax bracket, which means you will end up paying more tax. The key is that if you contributed at a higher tax rate, let's say 40%, but your tax rate on withdrawal is as low as 20%, this is a good position to be in. You're still saving on taxes. I recommend consulting your financial advisor for this type of withdrawal strategy to help you understand the exact amount you can withdraw while paying the least amount of tax. Alternatively, you can go online and use a tax calculator to check the tax rate for different income thresholds. This will help you stay below a certain threshold to keep your tax rate as low as possible. For me, I'd be comfortable paying 20% tax on RRSP withdrawals if I saved 40% when I contributed. So even at a 20% tax rate, I'd still be better off because I'm saving a significant amount. Contributing 40% tax rate, withdrawing 20% tax rate, saving almost 20% in taxes. Another strategy is to wait until your retirement years to withdraw money from your RRSP. Once you retire, your income should drop, and that's when it's ideal to start taking money out. Again, do it in smaller chunks to keep your tax rate low. It's also helpful to have savings in other accounts like TFSA or non-registered accounts. For instance, if your goal is to take out $100,000 in a year, because that is your expense, but you don't want to withdraw all of it from RRSP because that would push you into a higher tax bracket. Well, you can withdraw a smaller amount, say $25,000 from your RRSP to make up the difference. You can use savings from your TFSA or other accounts to fill the gap. Let's say the balance of the $75,000 can come from TFSA or other accounts or other savings. By doing this, you can avoid withdrawing a large sum from your RRSP which would cause your tax liability to increase. Over the years, it's important to take advantage of low income years to withdraw from your RRSP. Retirement years are the best time to do this as your income is generally lower during that period. By the way, I've made a separate video where I explain why you should not over contribute to your RRSP and what the right contribution threshold is. You don't want to contribute too much during your working years, because if your RRSP balance grows too large, it could be difficult to withdraw it later in life without paying excessive taxes. It's important to have a plan for when to stop contributing to RRSP and consider contributing to other vehicles like TFSA, which may be more beneficial for later withdrawals. I highly recommend you check out that video as well. Now, even if you don't need money in your low income years because your expenses are low, it's still a good idea to withdraw from your RRSPs. You can put that money into TFSA. So withdraw from RRSP and put it in TFSA or other investment accounts, which will allow the money to grow without being taxed. By withdrawing in these low income years, you reduce the balance in your RRSP and avoid paying higher taxes in the future altogether. Another way to withdraw money from your RRSP without paying taxes is through the home buyer's plan. If you are buying your first home, you can withdraw up to $35,000 from your RRSP without paying any tax. But you should, or rather you must, repay it within 15 years. This is a smart way to use your RRSP funds without paying taxes on it. Similarly, the lifelong learning plan also allows you to withdraw up to $20,000 from your RRSP to fund your education. Again, you must repay this amount, but you're able to use that money without paying taxes, which can be a great opportunity to invest in your education. These strategies, home buyer's plan and life learning plan, allow you to use the money in your RRSP for important expenses without paying tax, and you can repay it over time. If you're a first home buyer in Canada, another powerful tool to consider is FHSA. This account allows you to save for your first home purchase without having to pay taxes on the money you contribute or withdraw, as long as it's used to purchase your first home. So you can contribute up to $8,000 per year with a lifetime contribution limit of $40,000. This makes it an excellent vehicle for boosting your down payment while enjoying tax-free growth. So you move money from RRSP to FHSA, where once you take out that money from your FHSA to buy a house, you don't pay any tax on it. If you're interested in learning more about how to set up and use FHSA account effectively, I have a detailed video on my YouTube channel. Be sure to check it out for step-by-step guidance. Finally, make sure you withdraw as much as possible from your RRSP before your old age security or Canada pension plan kicks in. OAS and CPP are considered income, so if you start withdrawing from your RRSP after these programs begin, you'll end up in higher tax brackets. To avoid this, try to deplete your RRSP before your OAS and CPP payments begin. One last strategy to make use of in order to reduce your income in a particular year so you can take out money from RRSP and not pay tax on it is through a business loss. For example, if you withdraw $30,000 from your RRSP but have a business loss that offsets the income, you can reduce that taxable income. Let's say you have a YouTube business and in the first few years you show up a loss of, let's say, $50,000. In that case, you can withdraw $50,000 from your RRSP account and your net income would be zero. This way you pay no taxes on that RRSP withdrawal. Think about ways you can structure your business or investment to generate a loss in the early years. For example, a simple business like the one I run, YouTube coaching and teaching, can generate expenses that reduce your taxable income, allowing you to withdraw money from your RRSP tax-free. The key takeaway is that when you have a business loss, that's the perfect time to withdraw money from your RRSP because your net income is low and your tax liability is minimized. So whether it's through a business or another strategy, try to structure your income so that you can withdraw as much as possible from your RRSP at the lowest possible tax rate. All in all, it's best to have a strategic plan for withdrawing money from your RRSP, considering your current income, your future income, and the tax implications. You want to structure your withdrawals in a way that minimizes the taxes you pay, ideally contributing in a way that saves you taxes, and withdrawing in a way that keeps your tax burdens as low as possible. It's highly recommended to consult with your financial advisor to create this strategy, ensuring it aligns with both your current and future income. If you're interested in working with the financial advisor I use, I'll leave their contact details in the description of this video. Thank you for watching this video. Hopefully after watching this video, you will feel more confident about managing your RRSP withdrawals in a way that minimizes taxes legally and effectively. Thank you.